How's it going, guys? We got 10 stocks for next week's earnings. And as you can see, our earnings for next week is absolutely filled with a lot of solid companies. So the first one is going to be CocaCola reporting earnings before the market opens on Monday. And Coca-Cola, we're simply going to be buying and holding shares of this stock. Now, you can sell some cash cured puts, but overall, Coca-Cola is a very solid stock. It's a nice value stock, and overall it does pay out a nice dividend of 2.6%. So buying and holding shares for Coca-Cola with dividends reinvested is going to make you pretty wealthy over the long term. Remember, it's a long-term hold. You're holding it for decades, and overall that's going to make you pretty wealthy and a great investment. So next up on our list is going to be Microsoft reporting earnings Tuesday after the market closes. Microsoft, along with a lot of tech stocks, have been a little bit shaky. Highs of around $340 per share, and it's around 272 right now. Um, Microsoft, a solid company, as we can take a look at the 5 year chart. With all the ups and downs it's had, it's overall been a steady, solid growth company, and I love Microsoft for that reason. So buying and holding shares for Microsoft is another solid strategy, and they do pay out a dividend. Although it's not that high, it's only less than 1% dividend yield. It's still a nice added bonus to see some tech companies giving out some money to their shareholders. So buying and holding shares of Microsoft is a solid strategy. Next up on our list is going to be Google or Alphabet, reporting earnings Tuesday after the market closes. Very, very solid company. I love Google. They basically have a monopoly on the search engine. They do a lot of stuff in the cloud as well. And overall, a very big company and very, very big growth company. So we really like Google, and especially with the upcoming stock split, the shares are going to be a bit cheaper. So that's going to be very good for people who don't have access to fractional shares. And it's also going to be good for people who want to sell cash geared puts and those covered calls against those shares to collect some nice weekly or monthly premium. So another solid stock to watch for earnings next week. And then next up, we have Boeing reporting earnings Wednesday before the market opens. Boeing, it's going to be a nice recovery play if you can hold out the volatility. Boeing is struggling, as we can see here, past 5 years. Before the pandemic, it was around $300 per share, doing pretty solid. And right now, we're sitting at about half that. So it's yet to recover. Airlines are struggling, cruise lines are struggling. But if you can wither out that volatility and you can hold out for the long term, I do see these stocks recovering in the long term. But what you can do is you can sell some cash geared puts, and this is going to be just an example. Say a 1 week expiration, or you can even do a 2 week expiration, May 6th. You're going to collect some more premium on your money. You can go something like a $160 cash geared put, 83% chance of profit, 181 premium. So it's going to be a bit over 1% return in 2 weeks. And basically, if the stock stays above $160 when you're selling a put, then the contract is going to expire worthless. You collect the premium in full, and then you move on. If the stock drops below 160 at expiration, May 6th, then you just own 100 shares of the stock. And 100 shares of Boeing at $160 per share is going to be a nice dip buying opportunity. So, in my opinion, it's a win win situation. So, next stock on our list is going to be Spotify, reporting earnings Wednesday before the market opens. And Spotify has been pretty volatile. It's down 60% in the past year. So, very, very nice dip buying opportunity if you love this company, if you love this stock. Very volatile also, so you have to be careful. Highs of around $364 per share, sitting at $110 per share right now. So it's about 60% from its all-time highs. And it's actually lower than it was pre-IPO. So you have to be careful with this one. It's at its lowest levels it's been. Very volatile, and because it's volatile, it's going to have high premium. So you can sell some cash gear puts on the stock as well, and you're going to collect a lot of premium. So if Robinhood would load, we can see here we can go really far down on the strike prices. $85 cash gear put is going to give you $210 of premium. So you're going to be collecting a lot of premium on this stock. but it is kind of risky. As we can see, it's at its lowest levels as it's been before. A lot of stocks are giving up their gains, but this seems pretty safe. So you could even do an $80 cash gear put if you want to be a little bit safer, and it's going to give you a 2% return still, $150 a premium, 86% chance profit. I like this trade. So next up on our list is going to be Meta or Facebook stock. And this is going to be pretty volatile as well. As we can see, it's been sitting at $183 per share. So it's lower than it was before the pandemic. So it's went from almost $400 per share to 183. So it's given up a lot of its gains. Very risky stock, but I do like it for the long term. Honestly, it's a really good buying opportunity, and really good support around these levels, as we can see here. So if you have the money, you can sell some cash geared puts, or you could just buy and hold shares, or even call leap options, which is call options that are over a year out in expiration date. And that's going to be a risky play, but it could pay out big in the long term because this stock is completely oversold right now, in my opinion. But they're struggling right now. But they're working really hard with the metaverse. They even changed their name, Meta Platforms. So if the metaverse does play out in the long run, then the stock will definitely do really solid. So next up on the list is going to be PayPal. PayPal has given up a lot of its gains as well, down almost 70% in the past year. Highs of around $300. So it's about wow, it's getting killed right now. And it's pretty much back where it was before the pandemic. It's actually a little bit lower. I love PayPal. A lot of people still use it. And right now, honestly, a lot of stocks are just selling off, not just PayPal, but a lot of these other growth and tech stocks. So it's bringing down PayPal along with it. And honestly, I like this price point. It's at its lowest level it's been in the past year. So you can sell some options on it. It's going to be volatile, so we can collect some nice premium. And that's what we really want to do with earnings. It's either buying and holding shares or selling some options. And as you can see here, lots of good premium. You can sell like a $70 cash gear put, 84% chance of profit, and about almost a 2% return in 2 weeks. So pretty nice. And $70 per share is going to be a nice dip buying opportunity if you do end up getting assigned shares, worst case scenario. So next up on our list is going to be Apple. Apple reports earnings Thursday after the market closes. And Apple has been one of those stocks that's been doing well. As we can see in the past 5 years, it's just nothing but upward growth. Apple has a solid user base, very solid company, a very loyal consumers, which is very key to a company's growth. And it does pay a dividend of 0.5%. So just like Microsoft, it's not a lot. It's not a big dividend, but it does pay out something. So honestly, Apple is one of my favorite stocks. Buying and holding shares in my long-term portfolio has really proven itself time and time again. So just buying and holding shares of the stock is going to be pretty good. And just buying and holding and just not even doing anything. Don't even look or panic sell. And when you see dip buying opportunities like this past week, buying some more shares is going to be pretty good. So next up on our list is going to be Amazon. Amazon is also going to go through a stock split, so you're going to be able to get more shares at a cheaper price. So right now, sitting at a nice price point of just under $2,900. In the past year, it's a little bit shaky. Highs of around 37, all the way to lows of 27. So it's pretty volatile. But overall, Amazon, just like Google, huge company, big monopoly on e-commerce. But they're also doing other stuff like working in the cloud space. So I really like Amazon, just buying and holding long-term shares. Next up on our list, and lastly, is going to be Robinhood stock, which is a it's pretty controversial stock in my opinion, because a lot of people don't like Robinhood just because of during the short squeeze they ended up halting the buy button for AMC, GameStop, BlackBerry, all those other stocks. So a lot of people hate Robinhood for that reason. But overall, Robinhood is at its lowest levels it's ever been before. And I've actually used this stock many times just to sell some cash shared puts. But as you can see, it is in a downward trend. So we have to get in and out at the right time, which we have. So right now, It looks like it's at really low levels. $10 price point is really good support for Robinhood stock. So what we do is we sell weekly options on the stock in case of any huge volatility. And as you can see, high premiums. You can sell an $8 cash cleared put for a 1% return, 88% chance of profit. I like this trade, honestly. It only gives you $8 of credit, but if you sell multiple of these contracts, you can easily make up your money selling cash cleared puts on the stock. So that's about it. 10 stocks we're watching for next week. And of course, the markets are pretty volatile. We're in a bearish market. So we're just simply playing it safe, just buying and holding shares on these dips or selling some safe cash secured puts. Thanks for watching.